Imagine this, you're buying coffee at your favorite cafe. No cash? No problem. You wave your phone, and in seconds, payment is complete. In less than a generation, we've gone from handwritten checks to instant digital transfers. According to McKinsey, over 75% of global consumers now use some form of fintech, and that number keeps growing. Behind this transformation are innovators who didn't just ride the digital wave, they built it. These are the pioneers of fintech, the ones who dared to challenge traditional banks and rewired how we interact with money. Their stories reveal more than just technology, they reveal a revolution. The future of money is not cash, it's code, says Chris Skinner, a renowned financial futurist. This quote perfectly captures the spirit of fintech: software replacing systems, and data replacing guesswork. Fintech, short for financial technology, refers to tools like digital banking apps, algorithm-driven lending platforms, and mobile payment solutions. What once required a bank branch visit can now be done from your couch. This shift isn't just about convenience, it's about access, personalization, and control. And it started with visionaries who saw what legacy systems couldn't. Take, for example, two consultants who noticed inefficiencies in traditional credit card lending. Instead of tweaking the system, they rebuilt it entirely, using data to predict creditworthiness better and serve customers faster. Or the two friends who found existing mobile payment options clunky, and built an app that now powers billions in daily transactions. These fintech innovators didn't just think differently, they asked bold questions. Why does banking have to be so slow? Why can't loans be instant? What if trust could be built with code instead of paperwork? Their journeys weren't without struggle. Some faced regulatory roadblocks that nearly shut them down. Others had to pivot fast when their early models failed. But through it all, they held on to one powerful belief: money should move as quickly as people think. These entrepreneurs didn't just disrupt, they endured. They proved that fintech isn't about flashy apps. It's about solving real-world problems: access to credit, seamless payments, financial inclusion, in smarter, faster ways. So what does this mean for you? Whether you're a startup founder, an investor, or just someone curious about the future of finance, now is the time to pay attention. Fintech is redefining how we save, spend, borrow, and invest, and it's only getting started. As Steve Jobs once said, innovation distinguishes between a leader and a follower. If you want to lead in the digital economy, understanding fintech isn't optional, it's essential. Like, share, and subscribe to stay updated on how technology is reshaping the financial world, one tap at a time. And remember this: you are capable of adapting, evolving, and thriving in this digital age, because the future of money belongs to those who understand it. About the author. James DaCosta is a seasoned investor and former startup founder, currently serving as a partner at Andreessen Horowitz, where he specializes in enterprise software and financial services. Before joining the firm, he advised international clients during his tenure at McKinsey & Company and co-founded a fintech startup that was backed by Y Combinator. He holds an MBA from Stanford University, where he also led research on the economic implications of artificial intelligence. Key Takeaway 1. The Risk That Built Capital One: How Data and a Recession Changed Credit Forever. In 1990, while most banks were playing it safe, two consultants dared to bet on math over tradition, and changed banking forever. Picture this: you're applying for a credit card. Instead of a tailored offer based on your spending habits or creditworthiness, you get the same generic terms as everyone else. That was the status quo, until Nigel Morris and Rich Fairbank came along. In an era when customized lending was unheard of, they proposed something radical. What if banks could use data and algorithms to personalize offers and manage risk more precisely? This wasn't just innovation, it was disruption. Experts had long warned against one-size-fits-all lending. As Peter Drucker once said, the best way to predict the future is to create it. That's exactly what Morris and Fairbank set out to do. Backed by Signet Bank, they endured long commutes to Richmond, Virginia, chasing a dream no one else believed in. But the early days were brutal. Their ideas weren't catching on fast enough, and corporate patience was wearing thin. Then the 1990s recession hit, and paradoxically, it gave them space to prove their vision. As Signet scrambled to manage losses elsewhere, Morris and Fairbank quietly launched a balance transfer campaign that exploded in popularity. Their secret weapon? Relentless testing. Imagine treating every aspect of your business like a science lab. That's how Capital One, spun off from Signet in 1994, operated. From interest rates to promotional copy, every variable was tested, measured, and optimized. Like tuning a race car for maximum speed, their data-driven model let them fine-tune lending with pinpoint precision. It wasn't just innovation for innovation's sake, it was a new model of information-based lending that unlocked credit for millions who'd previously been overlooked. What does this say about the future of banking, and innovation in general? How many great ideas are buried beneath corporate impatience or lack of data? What might happen if more industries treated customer behavior as a roadmap rather than a nuisance? Capital One's origin story reminds us that disruption often starts in the margins, quietly, experimentally, and under immense pressure. In the middle of difficulty lies opportunity, Einstein once said, and this fintech revolution is living proof. If you've ever doubted whether a bold idea and some grit can change an industry, let this be your reminder. The story of Capital One shows that innovation in financial services, when paired with courage and timing, can redefine access and opportunity. So the next time you see a personalized credit card offer, remember, it started with two guys, a lot of data, and a recession. Key takeaway 2. How Capital One survived a $1.4 billion loss and changed fintech forever. What happens when a company built on experimentation faces its greatest crisis? At the peak of its rise, Capital One was known for disrupting the credit card industry with data-driven precision. But behind closed doors, co-founders Nigel Morris and Rich Fairbank had divided and conquered. Morris quietly engineered robust systems and recruited elite talent, while Fairbank fueled aggressive growth and marketing. Their dual leadership created a culture obsessed with innovation, a rare trait in the staid world of banking. As the company grew, so did regulatory scrutiny. In 2002, amid scandals that shook the financial world, Capital One found itself under the magnifying glass. Yet the true test came 6 years later during the 2008 financial crisis. The global economy teetered, banks crumbled, and customers defaulted en masse. In one brutal quarter, Capital One lost $1.4 billion. But unlike many of its peers, it didn't collapse, it adapted. As Warren Buffett once said, only when the tide goes out do you discover who's been swimming naked. Capital One, fully clothed, had prepared for the worst. What saved them? Data, discipline, foresight. Long before fintech became a buzzword, Capital One had already built sophisticated systems to assess customer risk individually. This granular risk modeling helped them mitigate fallout while other giants scrambled. Their story highlights a defining fintech principle: personalized financial services at scale, achieved through technology and relentless iteration. Even after parting ways with Capital One, Nigel Morris continued reshaping the industry. He co-founded 𝐓𝐚𝐤𝐧𝐠, Investors, a venture capital firm laser-focused on fintech startups. Backing over 225 companies, including billion-dollar unicorns, 𝐓𝐚𝐤𝐧𝐭𝐞 extended Capital One's legacy, fueling early-stage fintech innovation across the globe. Meanwhile, Capital One itself became a $50 billion banking powerhouse, blending traditional finance with cutting-edge tech. The journey of Capital One is more than a business success story, it's the blueprint for modern financial technology. It proves that when risk is met with rigor, and innovation is paired with foresight, even billion-dollar losses can be stepping stones. In a world where algorithms increasingly govern how money flows, Capital One showed how human ingenuity, data mastery, and courage to challenge norms can create enduring change. Key takeaway 3. How a forgotten wallet sparked a $250 billion fintech revolution, the story of Venmo. It started at a funk concert and ended in a fintech revolution. In 2009, two friends stood on a Philadelphia balcony, frustrated they couldn't tip the band without elbowing through a crowd. That small moment, seemingly insignificant, sparked a big idea: why couldn't you just text money? That question would launch what we now know as Venmo, a platform that processes over $250 billion in payments annually. This wasn't a fluke of timing, it was the product of global awareness and lived experience. 𝐓𝐚𝐤𝐧𝐭𝐞𝐜t had grown up in countries like Zimbabwe and Uganda, watching people navigate unstable currencies and diverse financial systems. Andrew Cortina, raised in modest conditions in New Jersey, learned resourcefulness early. Their paths crossed at the University of Pennsylvania, where shared interests in guitars and weightlifting evolved into entrepreneurial chemistry. Their complementary worldviews gave Venmo its unique human-centered DNA. Before Venmo, they tried, and failed at, multiple startups, a student marketplace, music platforms, even yogurt shop software. But failure wasn't the end. It was training. The breakthrough came one night in New York when Magdan Ismail forgot his wallet. Cortina covered the night. Paying him back later felt clunky and inconvenient. It was a pain point millions silently endured every day. What if money could move as easily as a text? This wasn't just an idea, it was a shift in how we interact with money in the digital age. They called it Venmo, a mashup of vendere, Latin for to sell, and mobile. The early version let users send payments via text, long before apps became dominant. Their real genius wasn't just the tech, it was recognizing a relatable, universal friction point and solving it elegantly. In a world still dominated by checks and cash, Venmo felt like magic. But it was built on deep empathy and relentless iteration, not luck. Innovation is born from inconvenience, someone once said, and Venmo proves it. What began with a forgotten wallet became a digital payments giant, reshaping peer-to-peer transactions and setting the bar for fintech user experience. It's a reminder that the next billion-dollar idea isn't always hiding in boardrooms, it might be in your pocket, waiting for a better way to pay. Key takeaway 4. How Venmo nearly failed, then transformed how a generation moves money. Sometimes the biggest breakthroughs come from the brink of collapse. By 2012, Venmo had caught early traction, 5,000 active users and $5 million in funding, but beneath the surface, a fatal flaw nearly doomed the company. In a bold move to attract users, they had allowed free credit card transactions, unintentionally creating a loophole. Users quickly exploited it to rack up credit card points without spending real money. It wasn't growth, it was a cash hemorrhage. With just 2 weeks of operating funds left, Venmo was on the edge. That's when Bill Ready, CEO of payment processor Braintree, stepped in. Needing a user-friendly peer-to-peer solution, he acquired Venmo for $26.6 million. The timing couldn't have been more serendipitous. Braintree needed Venmo's energy, Venmo needed Braintree's structure. Just 1 year later, PayPal acquired both for $800 million, giving Venmo the foundation for scale. From near bankruptcy to a fintech powerhouse, Venmo's survival was a masterclass in timing, synergy, and grit. Even as it matured under corporate ownership, Venmo refused to lose its quirky identity. Its legendary Lucas uses Venmo billboard campaign in NYC baffled passers-by, turning a mystery engineer into a viral icon. The buzz fueled organic growth and set Venmo apart from its slicker rivals. It wasn't just a mobile payment app, it was a lifestyle. And while Venmo owned the urban coasts, Cash App surged in rural America, carving out a digital divide in the US payment space. By 2023, Venmo wasn't just a platform, it was a cultural phenomenon. With over 85 million users, it had changed not just how we transfer funds, but how we think about money. Just Venmo Me became shorthand for simplicity, trust, and connection. What started as a tool for splitting pizza bills had evolved into a social currency, reflecting everything from friendship to personal branding. Crisis breeds innovation, and Venmo is living proof. From facing insolvency to becoming a household verb, its journey reveals the raw resilience and creative force behind fintech's success. It didn't just survive, it redefined how a generation engages with money in the digital age. Key takeaway 5. How a poker game sparked a bank, and a $42 billion collapse. It started with a poker game, and ended with one of the biggest bank collapses in US history. In 1983, two Bank of America executives casually tossed around an idea during a card game: what if there was a bank just for startups? One that served the high-risk, high-reward world of tech entrepreneurs and venture capitalists that traditional banks avoided? That idea gave birth to Silicon Valley Bank, SVB, a bold financial experiment planted right in the heart of America's innovation hub. The riskiest thing is not taking any risk, Facebook's Mark Zuckerberg once said. SVB embodied that mindset. While other banks saw fragile balance sheets and unreliable founders, SVB saw possibility. It didn't just manage money, it built bridges, connecting startups with VCs, offering flexible credit lines, and crafting financial products tailored to tech's unique rhythms. Over nearly 4 decades, its patient, ecosystem-first approach paid off, growing deposits to $100 million by 2019. But then came 2020, and with it, a tsunami of venture capital funding. As interest rates plummeted, startups raised massive rounds, and SVB's deposits doubled in just 12 months, skyrocketing to $200 billion. What had taken 36 years to build, SVB matched in a single year. Its transformation was staggering, from niche bank to the 16th largest in the US, serving clients like Airbnb and Pinterest. From the outside, SVB looked unstoppable, a true pillar of fintech and innovation finance. Yet buried in that rapid growth was a dangerous flaw. Flush with cash, SVB made the classic banking move, investing heavily in long-term government bonds. But as interest rates climbed in 2022 and 2023, those once safe assets plummeted in value. When word got out, panic spread. In just 24 hours, customers yanked $42 billion, triggering a historic bank run. Within 48 hours, SVB was gone, a towering giant toppled by miscalculating the basics it once defied so brilliantly. SVB's rise and fall is more than a cautionary tale. It's a window into the tension between bold innovation and timeless financial principles. In the end, the bank that bet on startup risk was undone by ignoring its own playbook, a dramatic reminder that even in the digital age, some fundamentals still rule the game. Key takeaway 6. How a frustrated father reinvented health insurance, and raised $375 million. What if trying to find a pediatrician was as frustrating as playing a broken video game? That's exactly how Mario Schlosser felt when his wife became pregnant and they tried navigating America's complex healthcare system. Endless Google searches, vague advice, and opaque costs left him frustrated and inspired. Out of that chaos came 𝐅𝐲𝐬𝐧𝐭𝐞𝐜, a fintech-driven health insurance company that would turn his personal pain point into a multi-billion-dollar solution. As a former gaming entrepreneur, Schlosser knew how to design virtual systems that keep people engaged. He took that same logic and applied it to healthcare. What if you could earn Amazon gift cards for meeting your daily step goal? Or get cash rewards for getting a flu shot? 𝐅𝐲𝐬𝐧𝐭𝐞𝐜 gamified wellness, using smart incentives to nudge people toward healthier habits. It wasn't just novel, it was effective, leading to sky-high customer satisfaction and eventually a $5 billion IPO. But innovation rarely comes without turbulence. When the Trump administration tried to dismantle the Affordable Care Act, 𝐅𝐲𝐬𝐧𝐭𝐞𝐜's very existence was threatened. The company survived by pivoting fast and securing a $375 million investment from Alphabet, the parent company of Google. Like many fintech success stories, 𝐅𝐲𝐬𝐧𝐭𝐞𝐜 rode what venture capitalists call the power law, where a single extraordinary win offsets a portfolio of risk. It's the same principle that underpins both insurance and venture capital, industries built around betting on uncertainty. Success in venture is not about avoiding failure, it's about finding the one breakout that changes everything, says Stanford professor Ilya Strebuliev. His research reveals that if you remove the top investment from most venture portfolios, performance plummets, highlighting how outlier wins define the game. That's why even top VC firms now offer more than just capital. They bring operational support, branding, and product expertise to nurture the next unicorn. So what's the real takeaway here? Whether you're innovating in health insurance, investing in startups, or navigating your own path through uncertain times, the key to success lies in mastering unpredictability. 𝐅𝐲𝐬𝐧𝐭𝐞𝐜 proved that even in the most complex industries, understanding human behavior, and being bold enough to reinvent the rules, can lead to groundbreaking impact. In summary, in Fintech Wars, James DaCosta takes readers on an extraordinary journey through the modern financial revolution, one that started not in boardrooms but in late-night poker games, forgotten wallets, and grueling commutes. This is the story of how visionaries and underdogs reimagined the world of money, turning complex systems into user-friendly tools and reshaping how we save, spend, and borrow. The book begins with Nigel Morris and Rich Fairbank, two consultants who dared to propose that credit cards could be tailored to individual risk profiles using data. At a time when banks treated everyone the same, their radical idea faced internal resistance and public indifference, until a recession gave them room to prove it worked. That experiment became Capital One, a data-powered behemoth that pioneered information-based lending and brought credit access to the underserved. DaCosta then introduces us to 𝐅𝐲𝐬𝐧𝐭𝐞𝐜 and 𝐓𝐚 Ismail, two friends who turned the pain of a forgotten wallet into a revolution in peer-to-peer payments. With Venmo, they not only simplified money transfers but made them social, fun, and culturally relevant. Their resilience, surviving near bankruptcy, an unexpected acquisition, and intense competition, proves that the best fintech innovations come from solving simple, everyday problems. We also explore the rise and fall of Silicon Valley Bank, whose roots trace back to a conversation over a poker table. SVB thrived by embracing tech startups when others saw only risk. But as DaCosta shows, its incredible ascent to the 16th largest bank in the US was followed by a dramatic collapse, reminding us that even pioneers can falter when they overlook foundational principles. The narrative then shifts to 𝐅𝐲𝐬𝐧𝐭𝐞𝐜, where Mario Schlosser transformed personal frustration with the healthcare system into a user-friendly insurance experience. By using game design principles to reward healthy habits, 𝐅𝐲𝐬𝐧𝐭𝐞𝐜 redefined what insurance could be, and, despite facing political and financial threats, the company soared. Its journey is a powerful example of how empathy, innovation, and grit can create real-world impact. A recurring theme throughout fintech wars is the power law of venture capital, the idea that a few big wins can define an entire industry. From the rise of 𝐓𝐚𝐤𝐧𝐭𝐞𝐜's Alphabet's Lifeline to 𝐅𝐢𝐬𝐧𝐭𝐞𝐜, 𝐷aCosta illustrates how the venture world bets on outliers, echoing the uncertain nature of the fintech journey itself. Success, he reminds us, is not about playing it safe, it's about placing bold bets on bold ideas. What sets fintech wars apart is how deeply human the stories are. These aren't just tales of apps and algorithms, they're about resilience, vision, and people who saw opportunity where others saw only risk. Through each chapter, we see that financial innovation isn't cold or technical, it's personal, messy, and profoundly transformative. If you've ever wondered how modern money moves, or dreamed of building something impactful, Fintech Wars is your playbook and your inspiration. Like, share, and subscribe to the channel to help spread these powerful lessons far and wide. And if no one told you lately, remember this: you are loved, you are worthy, and you are spectacularly capable of extraordinary things.